Now, one of the ways in which global equity investors choose stocks, make their investment decisions, is via a top-down approach. Now, this is where the investor will start their research journey by looking at the big picture. So looking at the global economy and then looking at filtering downwards from this big picture. That is, first they might look to find the best region or the best country at the moment to invest in. What country has the best investment potential? Then within that country, what industries, what sectors have the best potential? And then within those sectors, what companies have the best potential? So it's a best of type of approach to get to the final stocks that you put into your portfolio. This also goes along with a thematic type of approach. For example, at the moment, one of the big thematics is the AI revolution. That is, how do we take advantage of this new technology, especially from an investor point of view? Which company is going to make money out of this thing? However, when you do this type of approach, sometimes you can get it wrong. For example, in the 2000s, early 2000s, 2010s in particular, there was a major thematic rolling around equity markets, and that was the rise of the Chinese consumer, the rise of the Chinese middle class. In particular, how might the minting of millionaires every day and billionaires, the large economic growth that they were producing, how might this translate into investment returns? And so this saw a lot of investors shift part of their portfolios into emerging markets, in particular into Chinese equities, to try to take advantage of this thematic. Now, some things have gone wrong with that thematic, COVID in particular, and Chinese economic growth has slowed to more peer type of, developed market type of growth rates. Still a little bit higher, but that really isn't the reason why investors may have been a bit disappointed with their shift into Chinese equities. Because overall, yes, the Chinese middle class has become wealthier, spending a lot more, and economic activity has been reasonably robust. However, in trying to take advantage of this thematic, one thing that investors have learnt is that there are different ways in which these big picture themes translate into the investment world. Because it wasn't Chinese banks and Chinese airlines, Chinese retailers necessarily that were the big winners out of the growth of the Chinese middle class. In fact, it was more your European retailers, European luxury retailers, your car manufacturers also had some wins there, or some did. US companies as well, big multinationals in particular, tech companies, fast food companies. These are the types of companies that did leverage well into this Chinese story, and were able to provide investors with superior returns. So I guess the overall point is that your macro analysis isn't as easily translated into your final investment strategy. Large economic returns often don't mean large equity performance, and vice versa. Poor economic returns doesn't always mean poor equity performance either. There are a number of things at play, and so it's important for investors to understand those things and not to get caught in perhaps more simple strategies that might not necessarily play out in the long run.
Now, eagle-eyed viewers may have spotted some familiar landmarks in this video, so to play the Where is Dr. Dan game, head over to my Substack to be the first to log your location guess. See you next time.